Welcome to VeriScope News. I am your lead analyst. Our mission is to provide verified news, clear context, and a neutral, calm reporting environment. We focus on structural data over sensational headlines. Today, we examine a pivotal shift in the United States economy. Data released by the Labor Department and the Bureau of Economic Analysis reveals a growing gap between economic output and employment. This phenomenon is known as a jobless expansion. We are seeing record-level productivity gains paired with a significant slowdown in hiring. This report will analyze the latest jobless claims, the 4.9% surge in worker productivity, and the narrowing of the U.S. trade deficit. We provide the facts necessary for you to understand how these trends affect your financial and professional landscape. We maintain an advertiser-safe environment by adhering to objective analysis. Let us begin with the broad economic context of these developments. The fundamental link between economic growth and job creation is currently decoupling. Traditionally, a rising gross domestic product would necessitate an increase in the workforce. However, in the third quarter of 2025, the U.S. economy grew at a robust 4.3% rate, while private job gains remained stagnant. This marks a transition from labor-intensive growth to capital-intensive growth. Technology and automation are now the primary drivers of incremental value. This matters as a long-term trend because it suggests the economy is reaching a new level of efficiency. For businesses, this means higher margins. For the workforce, it means a period of structural realignment. We are entering an era where productivity determines the economy's speed limit. If output continues to rise without a corresponding increase in labor costs, the traditional inflationary pressures of a tight labor market are mitigated. This shift has profound implications for household stability and corporate strategy. Understanding this context is the first step in navigating the 2026 fiscal year. On January 8, 2026, the Labor Department reported that initial claims for state unemployment benefits rose by 8,000 to 208,000 for the week ended January 3rd. While this number reflects low overall layoffs, continuing claims provide a more detailed story. The number of people receiving aid after an initial week increased by 56,000 to 1.914 million. This is a proxy for hiring difficulty. Simultaneously, a report from Challenger, Gray, and Christmas showed that layoffs in 2025 jumped 58% to a 5-year high of 1.206 million. The technology sector and federal government accounted for the bulk of these reductions. Planned hiring by businesses fell 34% last year to the lowest level since 2010. There are currently only 0.91 job openings for every unemployed person. In a separate report, non-farm productivity was shown to have accelerated at a 4.9% annualized rate in the third quarter. This is the quickest pace in 2 years and follows a 4.1% growth rate in the second quarter. This surge in efficiency caused unit labor costs to decrease at a 1.9% rate. Furthermore, the trade deficit narrowed 39% to $29.4 billion in October. This is the lowest level since June 2009. The narrowing was driven by a tumble in goods imports, particularly consumer goods and pharmaceuticals, following sweeping tariff increases. While exports reached record highs, the primary driver was precious metals rather than manufactured goods. These data points collectively describe an economy that is growing more efficient but less reliant on new labor. To understand these figures, we must look at the 10-year averages. Productivity growth has typically averaged between 1 and 1.5% over the last decade. A jump to nearly 5% indicates a technological step change, likely driven by the integration of artificial intelligence and automated systems into corporate workflows. This mirrors the late 1990s, when the internet fundamentally changed business operations. The current hiring slump to 2010 levels is also significant. In 2010, the economy was recovering from a financial crisis. Today, the economy is growing at over 4%. This suggests that the low hiring is a deliberate choice by firms to prioritize margins over expansion. The role of policy is also central. The 43-day federal government shutdown in late 2025 prevented the collection of household data for October. This created a data vacuum that caused many businesses to pause their hiring plans. Additionally, high tariffs have restructured trade flows. The last time the trade deficit was this low was during the 2009 recession. However, the current narrowing is driven by a policy-induced drop in imports. This adds to GDP but signals a change in domestic consumer access to foreign goods. We are seeing a structural realignment where the economy is becoming more self-contained and highly automated. For the average household, the jobless expansion creates a state of low leverage. While productivity keeps the economy growing, the rise in continuing claims to 1.914 million means that finding a new job takes longer. This limits the ability of workers to negotiate for higher wages. If you are out of work, the search window has expanded, requiring larger emergency funds. For those currently employed, the focus has shifted to job security rather than job hopping. Wage growth is likely to remain flat as companies find they can produce more without adding staff. From a pricing perspective, the 4.9% productivity surge is a deflationary force. When unit labor costs fall, businesses don't need to raise prices to maintain profits. This is particularly beneficial for the services sector. However, this is countered by the impact of tariffs. While labor costs are falling, the cost of imported goods is rising. This creates a split in the consumer experience. Digital and domestic services may see price stability, while physical, imported goods such as electronics may become more expensive. The labor market is in a state of paralysis. Employers are reluctant to boost headcounts amid tariff uncertainty and the successful integration of AI. The ratio of 0.91 job openings for unemployed person is the lowest since early 2021. The leverage has shifted back to the employer. Workers are no longer in a position to demand the flexible terms seen in previous years. The focus for labor in 2026 is on upskilling and adapting to the automated tools that are driving these productivity gains. For investors, high productivity is a positive signal for corporate earnings. Lower labor costs per unit of output translate directly to higher margins. This explains why the stock market has remained resilient despite lackluster hiring. For savers, the Federal Reserve now has more room to manage interest rates. Since productivity is keeping inflation in check, the central bank may have the flexibility to ease rates later in the year, which would impact yields on savings accounts and bonds. Businesses are currently choosing capital expenditure over human capital. They're investing in software and equipment to bypass the complexities of the labor market. Large firms are the primary beneficiaries of this trend, as they have the capital to automate at scale. Small businesses might find it harder to compete in this high-efficiency environment. The narrowing trade deficit also forces businesses to domesticate their supply chains, which requires significant upfront investment but offers long-term protection from global volatility. Analysts are now focused on several key technical indicators. The first is the December employment report, specifically the unemployment rate, which is estimated to be 4.5%. Experts are also watching the labor force participation rate to see if workers are dropping out due to the slow hiring environment. The Atlanta Fed's GDP Now estimate of 5.4% growth for the fourth quarter is another critical signal. If growth remains this high while hiring stays low, it confirms the structural shift toward a jobless expansion. Finally, economists are monitoring the trade data for the first quarter of 2026 to determine if the import drop is a permanent trend. For our viewers, the takeaway is one of strategic caution. The economy is not in a crisis, but the job market is no longer a source of easy leverage. Prioritize your current role and focus on internal growth. Ensure your financial planning accounts for a longer job search duration if you are looking to switch careers. Budget for potential price increases in imported goods while looking for stability in domestic services. The 2026 economy rewards those who can work alongside automation. Stay informed by tracking the data rather than the sentiment. To provide a deeper technical context, we look at the methodology behind unit labor cost. This is calculated by dividing total labor compensation by real output. It is the primary indicator used by the Federal Reserve to gauge cost-push inflation. When productivity outpaces wages, unit labor costs fall, as they did by 1.9% this quarter. This suggests that the wage price spiral is currently non-existent.
Historically, periods of falling unit labor costs lead to prolonged periods of corporate profitability and low consumer inflation. However, this relies on productivity staying high. If productivity slows down while wages stay flat, the economy could enter a period of stagnation. This technical balance is why the productivity surge is the most important number in this week's reports. Thank you for joining this VeriScope News Deep Dive. We have analyzed the rise in jobless claims, the historic 4.9% productivity surge, and the narrowing of the trade deficit. These facts describe a highly efficient but labor-restricted economy. We remain committed to providing you with the data and context needed for a clear understanding. For more verified briefings, ensure you are subscribed to our channel. I am your lead analyst. Have a calm and productive day.